More Australian GDP concerns. Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of Heise Says. Once again with my stein of coffee, and I thought we'd look at this article about the GDP to hit its slowest pace since the financial crisis, because probably about lunchtime after this video premieres, the GDP figures will be released and we'll be able to see what they are. Now this is from the ABC. GDP, gross domestic product, to hit slowest pace since financial crisis amid weak business indicators. Yesterday we saw the PMI for CommBank that they released for all the manufacturers in Australia, and it did not scream of confidence in the slightest. But you know, that property boom, that 1% change is going to drive it all, because you know, buying houses, that's productive. So Australia's economy is already set to experience its weakest rate of growth in 10 years. But the latest business indicators suggest the economy could be faring worse than expected. Worse than expected. That just tells me that our methodology for managing and assessing it and blaming everything on spirit animals may not be the best approach to how we try and manage an emergent system, aka the economy. Maybe we should look at something else, you know? This Austrian school, how about we give that a shot for a couple of decades, you know? Just 20, 30 years, one generation, compare the difference. I really don't want Australia to go down this socialist path. I do not. It's going to suck. Okay, guys? Even if you prepare yourself for it, it's still going to suck for our kids. Anyway, yep. Many economists are expecting Wednesday, which would be today, GDP results to show the nation's economy grew by 0.5% in the June quarter. It would mean annual GDP growth would have lifted 1.4%, the weakest result for Australia since 2009 during the GFC. However, the final result could be even weaker due to the mixed but overall disappointing business indicator figures released by the Australian Bureau of Statistics on Monday. Businesses ramped up their spending on wages, operating profits skyrocketed, but only for mining companies, and there was a massive drop in inventories. Yes, there was a massive drop in inventories, and that's because they weren't ordering new stuff in to replace it. We saw that on the PMI. Falling inventories and insufficient stimulus. The ABS data revealed business inventories fell by a much steeper than expected 0.9% in the 3-month period leading up to June. It was a complete turnaround from the March quarter, during which they jumped 0.8%. The inventories data always come with swings and roundabouts, given they can imply stronger demand, JP Morgan economist Ben Jarman said. Essentially, it is the amount of money that businesses are spending on goods to sell to consumers, or the raw materials used to manufacture those goods. But with a soft retail volumes report and the healthy plant and equipment spending numbers already in hand, the demand side is fairly locked down, and so the new information here implies weakness on the production side, Mr. Jarman said. The sharp drop in inventories will wipe out 0.6% points from the already low GDP expectations. Whoa! According to economists from JP Morgan, CommSec, CommBank, Westpac and NAB. Mining, negative 1.5%. Wholesale trades, negative 1.1%. Retail, negative 0.9%. And accommodation and food services, negative 2.3%, were the sectors experiencing the biggest falls. The very real possibility of negative quarterly economic growth number makes it harder to sell the idea that recent stimulus will prove sufficient. What recent stimulus? In the last few months, there have been several attempts to stimulate the economy, from the Reserve Bank implementing 2 back-to-back interest rate cuts. Oh, that's their stimulus, to the federal government's income tax cuts and massive infrastructure spending plans. However, the weak business inventory figures might be offset by Tuesday's net export figures, also from the ABS. Reuters polling economists are predicting this will be add 0.4 percentage points to second quarter GDP. Wages spending hit a 2-year high. The amount of monies that employers are spending on wages and salaries jumped 4.7% since the June 2018 quarter, its biggest increase since June 2017. But adopting a smaller time frame, it was a 1.4% rise since the March quarter. Although employers are spending more on wages, this is not transferred into substantial pay rises for many workers. wage? Could it be overtime? Reducing staff and just paying those that you have more to get the same job done as needs be, perhaps? Some theory crafting there. Wage growth was stagnant in the June quarter, up to 2.3% on a yearly basis. CBA economist Linda Allen explained, this measure captures the impact of changes in wages growth as well as changes in employment. Due to the high volume of new jobs being created and the high unemployment rate, underemployment rate, 8.4%, it suggests that the increased wages bill is being spread across more workers. While workers' wage growth is sluggish, Australian firms' wage bills are growing at a faster pace than the decade average, reflecting a still solid labour market, CommSec chief economist Craig James said. Employers spent a lot more on administration, 12.7%, and utilities, roles, but nowhere near as much for construction jobs. There you go. The construction industry is being impacted by the downturn in residential construction, Ms. Allen said. The large pipeline of transport infrastructure work should support over time. We'll see. Mining profits are up again, but non-mining profits remain flat. Now we have to remember how much of our... And we'll bring up everyone's favourite website, the Observatory of Economic Complexity. Look at our mining, iron ore, coal, petroleum, gas, gold. Look at our export partners. Oh, that's where we're setting it to. Look at our export partners, I'm saying. I have to control this on my... there we go. On my little vMix screen thing, so it's a bit funky sometimes. So 35% China and Japan and South Korea. So let's just say, there's some issues with these economies here. Perhaps, maybe a trade dispute between two large countries. Yeah, perhaps. Maybe you've heard of one. How would that affect our mining profits? So mining profits dominate. Meanwhile, the operating profits of Australian companies surged 4.5% between the March and June quarters, more than double what the market had expected. This equates to a 12.5% boost in annual profits since June 2018, but a deep dive into those figures shows that it was the mining industry that by and far did the heavy lifting. I wonder if that's going to change now with the commodity prices of coal changing. We'll jump here. Let's look at some commodity prices, guys. Gold is up, fantastic. Silver, 18.41. That's good. Coffee, $93. Maybe I should buy some coffee. What am I doing, Florin? Come on. Coal, $66. So it's down from its peak. Iron ore, so iron ore is, well, in the last few days it's gone down. Coal, it's heading down. Last few days, let's change that to a month. Change iron ore to a month. There you go, 186 down to 85. So it's taken $100 off since 2010, give or take, in the last 8 years. What was it? 2011, coal was 130, down to 66. I remember these times. I remember that. We were working on all these big coal mines, and they wanted to put luxury things everywhere. So, companies in the mining sector saw their quarterly profits lift 10.9%, and yearly profits surge 31.9%. Strong commodity prices, in particular for iron ore, is boosting profits for this sector, Ms. Allen said. Nevertheless, the large foreign ownership of mining companies means a significant proportion of mining profits, around 75%, an RBA estimate, leak offshore. Okay, so that's much worse than I anticipated. Why is that happening? Why is that happening, guys? How many of these mining companies are also importing foreign workers or using driverless vehicles? Someone let me know. Oh well, that's fine. That's fine. I'm sure we'll be okay. I'm just becoming more cynical with age, I think. In contrast, profits for non-mining companies rose very slightly, 0.3% during the June quarter, but it was a relatively small annual gain since June last year of 1.5%. Overall, the mixed results, strong headline profits and higher wage spending, but a significant drop in inventories cast doubt on the credibility of the Reserve Bank's recent predictions about the Australian economy, which now appear to be too optimistic. Well, can any of their predictions have any weight? I mean, they're constantly proven incorrect. Constantly. I think their entire methodology needs to be questioned, but it's just the school of thought. It's the whole bloody Chicago school coming through. This will be a major disappointment to the RBA and suggest the RBA will have to downgrade its outlook further in the November statement on monetary policy. NAB chief economist Kixin Awang said, sorry if I got that wrong, the Reserve Bank's latest forecast suggests that a recovery in growth started in the June quarter, but that view appears very unrealistic. Wow, they thought we were recovering? So guys, what do you think? What do you think? Well, I will be interested to see what the results are for the GDP when they come out. But, you know, that's one thing. We need to adjust our GDP based on, you know, actual retention of funds in the country. If 75% of the profits of mining companies goes offshore, and, I mean, how much of our export market, let's have a look, how much of our export market is mining. What do we do here? Hang on. Oh. What do we have here? Mining. Look at that. All the export there, mining. So, how much of that is there? What? 131 billion of mineral products. Metals is 13.1 billion. So if... wait. Let's see if I can get... isolate. There we go. So, if a proportion of this revenue is of the profits from this sector is just heading overseas, 75%, should we be concerned? I can't say I'm surprised, but doesn't seem right, does it? Anyway, guys, like, share, and subscribe. Have a discussion in the comments, and I'll see you later.